Hello and good afternoon to everyone that's currently tuned in live with us on another episode of Phillip Trading Podcast. I'm your host for today and my name is Trent. With me here today is my colleague William, a senior dealer and marketing executive from Phillip Futures. How are you today, William?
Very good. Thank you, Trent. How are you?
Yeah, good. Good to have you back. Okay, so for today's podcast, we'll be discussing on the topic banking stocks are the growth stocks in 2022. So to our audiences out there who are currently investing in stocks market or interested to invest in stocks market, do not miss out this podcast. Okay, so once again, I would like the help of all our beloved audience today to share this video to all your friends. The more people that are watching this video, the more we are motivated to deliver greater content to all of you. Without further ado, let's jump into our topic for today. Banking stocks are the growth stocks in 2022. So with inflation hitting 40 years high, Federal Reserve is determined to raise interest rate 3 to 4 times in 2022. So we will be discussing on how rising interest rate would benefit the earnings of financial sector and how does banking stocks perform back in year 2015 to 2018 during the previous rising interest rate era. So pass on to you, William, to enlighten our audience.
Okay, thank you very much, Trent. Okay, so just like what Trent said, that what we are going to discuss today is that can banking stocks really be a growth stocks in this year 2022? Because for most of the people, we all know that banking stock is like the big cap. There is no room to grow, etc., etc. But can banking stocks really be we call them a growth stocks in this year? Okay, this is what we are going to discuss. But whatever that we share today is basically for knowledge sharing purpose, and it's not really a buy and sell call. Okay, so three items that we are going to discuss. The first one is we were going to look at the 4 cycles of the US economic after the QE back in 2015 to until 2018. Okay, we are going to look at the 4 economic cycle. Then we are going to look at how interest rate can benefit the earnings of the financial sectors. And the last one, we will look at some examples, some of the stocks that of the performance back in 2015 to 2018, okay, during the interest rate hike era. Okay, now the first one, which is the 4th cycle of the US economy after QE in 2014. Okay, so the first stage, or we call the first cycle, is usually the bond tapering cycle, which is what we are experiencing right now. Okay, so Fed announced in November 2021, which is last year, 1 month ago, that Fed is going to start to taper. Okay, this means that they are going to reduce the bond purchasing program, which is exactly this one. What we are in right now is exactly this one. So back then, when Fed starts to taper, this is exactly how S&P move. Okay, so after the bond tapering, US indexes or US economies basically enter into a recession due to the lack of liquidity. Okay, so from 2014 to 2016, basically US indexes, it just fell to go up higher due to the lack of liquidity because of the tapering. Okay, so after 14 months of the recession, they enter into an interest rate hike era. So US government or the Fed, they only start to increase interest rate when they think the economy is growing, not during the recession, but when the economy is growing, then they will start to increase interest rate. Okay, so basically this exactly period from 2015 to 2018, the Fed increased the interest rate from 0.25% to 2.5%. Regardless, if you look at it, the US, the S&P continue to go up in the interest rate hike era. Okay, and finally will be the quantitative tightening. This means that whatever that the Fed buy, okay, the QE, they try to release it, unwind the balance sheet to reduce the liability. Like what we have been reading the news, we have been hearing that the US government has too high debts. Okay, the debt level is too high. This is quantitative tightening, is exactly the thing that the US government do to pay down their debts, which is they sell the bond that they purchased during the QE back to the people, to the corporate, okay, to collect back the money to reduce the debts. So in this particular stage, basically US indexes, if you look at it, there is a problems going up due to the lack of liquidity again. Okay, so basically recession and quantitative tightening are the stages that kept the US indexes from going higher. Okay, so like I mentioned, Federal Reserve we start to taper in November 2021. Hence, right now we are only in this cycle, the stage one. Okay, so after we look at how US indexes perform, and what are the cycle after the QE, okay, we look at how the interest rate hike benefit the financial sectors. Okay, now if you look at if you want to know how does it benefit the financial sectors, first of all, we just need to understand how does the bank make money. Okay, basically the bank, in short, I'm just trying to describe this in a really layman term. Okay, so basically the bank, they just take advantage of the difference between the interest bank paid to the customer and the interest the bank will earn from their investing activity, from loaning to the customer. So in short, you place your fixed D with me if I'm the bank, and I take your fixed D, okay? So I pay you probably 1%, 2%, but I use the money that you place with me, I lend it to another customer probably at 3 or 4%. So I just earn the difference in between, okay? So which is that 2%. Now imagine if the Fed increased the interest rate multiple times this year, okay? When interest rate increase, you place your fixed deposit with me, let's say for 12 months, and I'm only paying you 2%, okay? But you need to remember that when the Fed increase the interest rate, the bank will increase the interest rate as well that they charge to their customer. Even your house loan, you will see your interest going up as well, okay? You will see you're going up as well, but your fixed deposit is being locked, okay? It's being locked for 12 months, for 6 months, that you will still get 2%. It's not going to increase. So this is where the bank will get even higher earnings. You know, the margin is going to get higher due to the increasing interest rate, because the bank can charge the interest out at a higher rate. Okay, it's just like a window of opportunity. It's just that one particular year that the bank will get more earnings meaning higher ability to pay dividends. Okay, this is exactly what drives the bank stocks going up. We call the growth because of higher earnings, higher dividend, you know, higher margin. So this is exactly when interest rate hike, there's a window of opportunity whereby customers place their fixed deposit at very low rates with the bank, and the bank can loan out this money at even higher rates. Okay, so the spread margin in between the changing rates by the Fed increase the profit margin of the financial sectors. Okay, this is exactly how the bank make money. So the more often the rate hike, the higher the profit margin of the financial companies. Okay, which is why when the Fed said that they are going to increase interest rate for 3 to 4 times in a year, basically this is quite beneficial for the bank, because the margin that they can get is going to get higher. The more that you increase, the higher the margin. Okay, so now let's just quickly look at how does banking stocks perform back in 2015 to 2018 during this previous interest rate hike era. Okay, we just look at it. So this is the first stock that we are going to look at is Bank of America. Okay, so the orange line refers to the US S&P indexes, and the blue line refers to the Bank of America. So if you look at it, this is something that I shared in my first slide. So the Fed basically increased the interest rate from December 2015 until 2018. Okay, so look at how Bank of America performed. So Bank of America was somewhere like 12, 13, 14 back in 2016 when the interest rate just started to increase. Okay, so when the interest reached a peak here in 2018, basically the Bank of America, the share price drive up from 14, 15 to about 30. That is about 30 plus. That is about 100% movement, okay, throughout the entire interest rate hike era. Okay, now let's look at another stocks, JP Morgan Chase. Okay, again, it's the same. The orange line refers to the S&P and the blue line refers to the JP Morgan's share price. So back in 2016, JP Morgan was trading about $55. Okay, but until the entire period from 2015 to 2018, JP Morgan was trading at about 115 at the end of the interest rate hike era before they start to reduce the interest rate again. So that is about another 100% increase from 50, 55 to 100, 110. Okay, now let's look at one last example, which is the Wells Fargo. Okay, so blue lines refer to Wells Fargo. So if you look at it, Wells Fargo was trading at about 42, 43 back in 2016 when the interest rate is still at 0.25%, which is exactly what we are in right now. Okay, what we are in right now, 0.25%. So when the interest rate increased from 0.25 to 2.5 over the 3 years period, Wells Fargo share price moved from somewhere like 44, 45 until a peak of 60 or 60-ish. That is about almost 50%, 40% to 50% movement over the 3 years period. Okay, so basically, I'm not saying that banking stocks is definitely going to move. Okay, first of all, but at least we know that banking stocks are very, very likely to be a growth stocks in 2022. Okay, so we all know that what drives a share price, definitely growth. So as long as there are growth, there are higher dividend paying abilities, definitely equivalent to higher share price. This is exactly why we are saying that banking stocks are considered as growth stocks in 2022. Okay, and rising interest rate basically give banking stocks higher profit margin, hence higher ability to pay dividend. And if we look at the history is going to always repeat itself. Okay, things are just, it's an economic cycle. This thing is just, it's not like rocket science. These are just economic cycle. So banking stocks in the past basically just benefit from interest rate hike. Okay, as we witnessed in 2015 to 2018. So this round, are we going to see the same thing? I'm not sure, but definitely the opportunity, the possibility is there. Okay, yeah, and also for those that are interested to trade all the stocks that I mentioned, the Bank of America, JP Morgan Chase, or even Goldman Sachs, and some Wells Fargo, all these banking stocks that you are interested to trade, you are able to trade with us at a margin, a very attractive margin through the CFD. Yeah, basically that is all my sharing. I'll pass it back to you, Trent.
Okay, thank you, William. Thank you for your sharing, and I hope what you have shared will help our investors out there. So to our audience, right, who are interested to invest in US banking stock, like William mentioned, you can now trade NYSE and Nasdaq stock CFD with Phillip Futures. So with a margin of as low as 10%, investor with smaller capital can now invest in listed companies on NYSE and Nasdaq. So for more details, you can drop us a message on Facebook and our representative will get back to you. And now we have come to an end for today's podcast. If you have any question or any topics you want us to discuss next week, you can message us in the comment box below. Thank you for listening to our podcast and happy trading for the week. Thank you for your time too, William.
Thank you, Trent. Okay,
bye-bye.
see you next round. Bye-bye.